Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, September 20th, 2023. It is 4:53 p.m. Eastern Time as I'm starting the video, so markets are closed, and we're going to go over really those things I've been watching, the big stuff. As usual, start out with the indexes. I don't need to go super deep. Just a reminder, or if you're new to the site, anytime you want to catch up on, more detailed analysis, something dig deeper in the charts. Sometimes we'll do a 30-40 minute video only on the stock index as example, for example, or the gold mining stocks or whatever it is. At the bottom of each post, if you click on the symbol tag on the home page, it'll say tagged with, and if you click SPY or QQQ, and there's also, it'll bring you to all the posts in chronological order, whichever tag you click on, anything covered in there. And then there's also at the top of the site the categories. You can click on market analysis, equity market analysis, fixed income, whatever you want. So that's how you can kind of get a little bit more of what I've gone over recently. So we'll do a quick overview here, starting out with what's probably the most important thing today, and that's the breakdown or really the follow through, if you will, in QQQ. Again, let me say it one more time. Anytime you have a Fed announcement day, you're going to get some volatility post announcement. And whether it's the initial move at 2 p.m. or whatever it does at 2:30 p.m., the press conference when Powell talks, quite often those moves are reversed. So you still at this point have to take it with a little bit of a grain of salt, but of course you have to take it with, or you can take it with less of a grain of salt, if that makes sense, than you did at 2 p.m., right? Because the day's over, the press conference is over. That, like I said, was going to have most likely a bigger impact on the markets today because it was baked in the cake. They were not going to cut rates. They were going to keep them steady. So the 2 p.m. announcement was no surprise to the markets or anybody out there. So it's really, market's interpretation of what Powell said in the press conference. So, but, again, we'll know within the next few days. As every day goes on, every day you get away from that 2 p.m. announcement, the odds that it's going to be a whipsaw decrease. Usually if you're going to get a whipsaw, it's going to be within the next couple trading sessions. So we'll hopefully have a good clue by Friday. But let's do this. Let's just, like I like to say, take the charts, the technicals on face value. And if you do that, then we had a solid breakdown today. In fact, I'll zoom in. I've been highlighting these two lines. I color-coded them in red recently. The primary uptrend line right here, the 2023 uptrend line, which broke down yesterday. And as I said, take that one with a bigger grain of salt because it was pre-Fed and you closed right back about on the line. I have to zoom in here. You can see that red candle. It's so flat. That's the body, the fat part is where we open and where we close. And then the skinny part, they call that the shadow of the candle. Up above, it's the wick, and the shadow down below is the tail. Those are your components. That's the daily range, how high and low they got. So yesterday, you can see between the open and close, we closed right about open and closed right on the trend line, just like we did the previous day. But it was, again, if you take it just on face value, it was a breakdown. We traded below all day, and opened and closed below it. And then today, now that's what you'll want to see when you break down that rejection candle. And if it didn't occur on a Fed day, I would say it's my all-in moment, or at least a very heavy. But of course, it was enough to add some short exposure, and even did that intraday. I mentioned that, and I trailed stock, closed. I did part of that as a day trade. I was using 5-minute charts, and then put back on a swing position with just stops set in place. So, and they'll stay there for now. So pretty much if we pop much above today's highs, we're going to be back above the trend line, and every tick higher solidifies that this whole thing was a false breakdown. But as of now, it's not a false breakdown. It's a breakdown. It's the breakdown that I was favoring and expecting with all along for weeks now. And what it does, me, my little odds, real-time odds counter, it just gives me another check mark in the bearish case and increases the odds that my preferred and primary scenario is going to play out. And that is, again, if you're new to the site here, just catching up, my primary scenario says this was the end of a bear market rally and the beginning of the next leg down in a bear market that has convinced most people it wasn't a bear market anymore, if that makes sense. So by many metrics, it's still, and in hindsight, we'll know for sure if we take out the October lows in the stock market, that's when we can say definitively it was, nothing more than just a bear market rally. But as of now, that's my working thesis, if you will, and that's what we're going off of, or I'm going off of. And so the fact that we broke down, and that was a big one, this trend line, we've had multiple tests on it recently, and it broke down. Now, all along I've had a level here at 365. I'll turn it up a little bit. I'm just trying to clean this chart up, but I've had that level here for a long time, and it's still a significant level, and that's right about where we close for all intents and purposes, 364.54. So you're talking 46 cents on a 365 point security. That's virtually a perfect close right on support. So now the way that works is tomorrow, if we can take out that support, that'll further help solidify the breakdown and the case to be short. Bearish PPO crossover recently on the daily. So I'm leading here with the bearish developments today, and I'll get to some potentially bullish ones here in a second. Things to watch for. That's what this site's all about. Levels, I try to get them out in advance. Nothing irks me more than hindsight analysis. Hey, I bought this at this price, or I knew the market was going to go up. I just didn't say it. I try to get these things out in advance while they're actionable. And, when I do highlight something that I missed, then I'll use that mainly as an educational example. Hey, I missed this, and this is what, probably why that trade didn't pan out. And that's about the only time I like to really focus on things that happened that I didn't point out in advance. So QQQ broke down. So that's at support. When you look at this, let me go to my clean board here. I'm probably spending a little bit more time on it than I wanted to, but it was the biggest development today. So yeah, this is a cleaner board right here. And let's turn off all the lines for a second and look at the volume at price histogram bars, VAP right here, edit, turn these up. And so what these show you is where all the trades have occurred. So we're going back. Let's just go with this year. We had a big rally. I'm scrolling now to the beginning of the year. Here's January. Let me just tighten that up a little bit. Can't use my mouse scroll wheel. I have to zoom it in there. Okay, so that's got us right about to the beginning of the year. There it is, January 3rd. Okay. So what this tells me is so far this year, especially in the last half of the year, there's the middle of the year right there in June, and it tells me that almost all the trades occurred right here in this block right here, and especially right here in this line. You can see by far this is where the vomit price is. So it says most people bought. And we know this. These were bulls that they didn't want to buy the lows back in the beginning of the year when we were long the overweighted Apple and Amazon and big tech. They wanted to buy the rally here. And it's just, and I know I'm sounding a little facetious, it's just the way the markets have always and will always work. The masses will tend to buy tops and sell bottoms, all right? And the smart money will get in and do the opposite. But what this tells me definitively is that most trades occurred in here. So we know there's a lot of supply right there. We're still on that level. So you can see it really lines up with about 360. And then it gets very thin, meaning very few bought this quick move up. I believe that coincided with NVIDIA's earnings when they set the AI hype machine running. But you can see here very few. And what this does is this thin zone here, I would say it's similar to a gap in a stock where there's no trades. In this case, you had very few trades occur, but it's the same net effect. Very few buyers there. So another way, let me spin this another way. What this tells me there is if vast majority of people bought up here in this range, then there should be a lot of stops here. And if there's not hard stops already set that will be hit, and then when a stop is hit, what does that do? It sells you out of your position. That's a sell order, and it increases. And the whole reason that stocks or a market or an index or a commodity goes up and down, simply economics 101. If there's more buyers than sellers, it's going to cause the price to go up, more sellers than buyers. So if those stops get hit, plus even if there's not hard stops in there now, these people, and that's a lot of people, go underwater, and then they start to change. They become less bullish, less apt to buy, more apt to sell, and then that could take us down pretty quick. So that's that. And again, that's part of that is the game plan, if you will. It meshes with, let me just turn that back down so it's not too busy here, kind of meshes with my targets. I have different boards, but for the most part, this is it. And I think I gave you, yeah, I did. I gave you some targets, official targets recently on here. And it just shows that if we get down there, it'll probably be a relatively swift move down to about the T4 area right there. Another way to spin it is once we clear that, what did I tell you? It was around a little bit below here, about 360-ish. Especially, you know, I've had this red line here forever. That's my second red line. That's kind of the final, you know, straw that should break the camel's back if we get below there. So 354.70, and that was that August 18th low I've been harping on. And then that should, again, the point is that should take us pretty quick, at which point I would, again, if things change or depending on what I see on the intraday charts and other things, most likely, especially on my swing and trend positions, assuming I haven't flipped back to long or bullish, if we get down there, I'll probably not want to cover and game any bounces on T2 and T3. I probably want to just hold out because I expect it to be, for the reasons I just said, a relatively swift move down with minimal buying and kickback rallies in here. And again, what I'm doing now is getting 2 or 3 steps ahead of myself. Just so you know, I'm just giving you a game plan in case things happen fast. I've done this long enough to know that from periods of low volatility comes complacency, and people tend to think it's recency bias, that the VIX is very low and there's no volatility and we can't do this. Very few right now, other than myself, probably believe that we can drop in a matter of a week, 2 weeks. That's maybe on the extreme end, but I could easily see that happen. That is about 11% from where we are, and so if it does, it could happen pretty quick. And the point is, if you're just a few days late, you miss an objective entry if you're not already short. Okay, so let me get to the rest of it now. Again, that's QQQ. And then SPY also, I believe I have a clean board. Maybe not. I'll add it. Yeah, this is my clean board, but there's a trend line on this one I need to replicate. So let's just move this line over to board number 8. And it'll show there. And then I'll go to that board. It's a clean board, and there it is. All right, so boom. Boom, boom, boom. Price support as well. Pretty good price support, mind you. Others here have pointed out, and I've seen it too, potential head and shoulders pattern forming there on the S&P 500. This would be your left shoulder. If you're not familiar with what those are or anything I mentioned on the site, then look it up. That's your head, and this is your right shoulder, and this is your neckline here. And so your neckline, in this case, you have actually a slightly upward sloping neckline like this. That's the best fit. And then on a head and shoulders pattern, they are topping patterns. You take the widest part of the pattern from the head down to the neckline, and you add that to where the pattern breaks down, and voila. And I just freehanded that. I didn't, if you want to do it accurately, you just take a trend line like this, like I just did, put it on the highest point, take it down to the line. I even keep the angle the same, and then I add that down, and that would show your measured target. And that measured target is going to take me a little shy of my price target. And so when this happens, what do? I will always, not always, I shouldn't say always, that's a word I try not to use in this game of trading and investing, because there's always always some kind of a caveat or thing in there may change. But I typically will cover at the price support, especially if it's a little bit above it. I'm not going to try to eke out an extra percent. Now, I don't have a position in the S&P 500 right now, but if I were to and I was trading SPY, I'd still, again, depending on where the charts are at the time, something might convince me to hold out for a, meltdown scenario. If something's breaking, I'm watching, me, I watch a lot of stuff, more than probably many do. I look at every facet and component of the financial markets, from commodities to niche, finance companies to municipal bonds in various states, and whatever things that might give me a little insight to what's going on, because more things will break. I forecast that a long time ago. I know some other people much smarter than me did as well, and things did break. We had 3 big banks, 2 of the largest in U.S. history, break And that's a big thing. And at that time, I and others also predicted that's just the start. That's not the end of it. That's just a shot across the bow. So I'll be watching for that. And where I'm going with that is, if we have just a correction in an orderly fashion, let's not get too bearish right now, and that may be a good time to cover and go long. And that's what I'll most likely be doing. However, if I'm looking at a bunch of red flags, those that I've been mentioning, the municipal bond market, the Treasury bond market, corporate bond market, I'm watching LQD, investment grade corporates, I'm watching junk bonds, HYG and LQD, I'm watching all kinds of financial institutions, not just the banks, but including but not limited to JP Morgan and MasterCard and Visa and payroll processing companies like ADP and you name it. So looking to see, where some, signs are that might say, you know what, it is finally everything's coming to fruition and things are starting to break, and maybe just tuck those shorts away and hold on for what could be a bigger move down. But again, I'm getting 3 steps ahead of myself right now. Step 1, let's take out that neckline. And really, we have that BOD or benefit of the doubt support about 433, just below that on SPY. And then going back to QQQ, you also have a pretty much a head and shoulders going on there as well, with a left shoulder, head, right shoulder, neckline like that. So, break that and we're going lower, and that's a topping pattern. It's not the only topping pattern. Remember, we put in a divergent high on QQQ. At the high recently, we put in not just a divergent high, but also a nice big fat bearish engulfing candle on SPY. And so there's plenty of technical evidence to say it tops in, and that's the bearish stuff. Now, what I can't rule out yet, yes, the odds definitely went down. All along for months now, I maintain my primary and alternative scenarios, both of them being longer term bearish scenarios, but my primary scenario being that this was the high and we're going to zigzag down and ultimately go on down and eventually a lot lower than T5. These are initial swing targets. But I'm still open to maybe this was just a little post-Fed whipsaw, and I'll show you some things to watch that might indicate that. One of which, probably the biggest, which would be a solid recovery back above that uptrend line, as well as the one I showed you in SPY that broke down. Next up would be the primary downtrend line. You can see I have a downtrend line off the highs here, and price resistance. So boom, boom, boom. Do all that, the odds are going to sharply go. If you want to play the numbers game, let's say all along I was at, let's say, 40-60 or 45-55, meaning 55 my primary, 45 my alternative. And again, make no mistake about it. To me, that's not wishy-washy analysis. That's when I'm speaking long-term time frame. It's very bearish. It's at most it had us going up a couple percentage points, few percentage points off that other high, and that's still on the table. But let's say now that's dropped down to 35.65, and I know I'm giving no margin in there for outright wrong, whatever number you want to put on that, meaning if we go up more than a marginal new high, if we take out the highs by 10% or more, then I'm just flat outright wrong on that market call. So let's just work with primary, alternative. So today, in my opinion, because of the breakdown, the odds of the marginal new high probably went down from about 45 down to maybe about a third or so. We'll call it 30-35% chance that we could still do that. And those odds could change very quick if we pop up here and even flip over, as I just showed you, the levels where, to me, they flip over well over 50% if we do this, and if we do it soon, because this whole thing will be a false breakdown, aka bear trap, and so those odds can change, or they can continue to diminish. So that's how it works. So as of now, let's just play that game. We'll call it 65% chance. We're going to continue. When we take out T1, those odds are going to jump up to, better north of 80%, in my opinion, that we're going to go on down and hit this, at least at least T4 there at 322. Oof, okay, that's a lot, but it's important because, and that's why I always lead with the equity market analysis, helps align the other trades. Me, and especially in recent months, I've highlighted more and more individual stocks and sectors, and that's what you want to do when the market's going sideways, as it has been for months. I've talked about that. Where we're at today, is exactly where we were trading back over 3.2 months ago right here. It's like you can see on the pop-up box. And so we went up a little bit, just a couple percentage points, few percentage points, and down a little bit. It's a big trading range. So a buy and hold investor has made nothing. They're right back to where they started 3 months ago. They were up a little, down a little, and they're there. So where the opportunities have been for a swing trader, and that's what this site's all about. If you're going to be a buy and hold investor, listen to the late great John Bogle, and put all your money in index funds, and if your time horizon's 20-30 years, you'll make some money. You're going to have some big drawdowns in between then, but that's what you want to do. If you have the time and skill sets and inclination and interest like I do, you can definitely make money. In my opinion, my experience, outperform the market by swing trading, meaning getting in the most bullish sectors when the charts say get in, swing it up for whether it's a week, 2 weeks, a few months, 6 months, 6 days, anywhere in between. I have short-term, long-term swing trading, anything longer than 4, 5, 6 months, kind of trend trading. That's what I'll refer to that as. Much more importantly, the stock market's one vehicle to trade, but you're kind of spinning your wheels, especially when there's things are changing in the macro fundamentals, and that's what's happening. So there's been a lot of sectors, and that's what I've highlighted, individual stocks and sectors that have had huge gains, and clear trends and breakouts and all that over this time period, and that's where the opportunities have been. However, once this trend, if and again, I'm just going to go off a bunch of big ifs here, assuming we have peaked, and what I was saying before, if I'm right, this downtrend should begin to accelerate once we break under T1, and it's also what I call the point of recognition, where the masses realize, ruh-roh, something's wrong here. What happened to the whole no landing scenario that everyone's been talking about? It went from hard landing to soft landing and then to no landing recently. And so when there's a paradigm shift in the collective mindset of the masses, that leads to quick sentiment changes, and then that leads to position changing. In other words, selling and less buying. It's two components. Stocks can drop right now on just if the buying dried up. And I think that's what's happened. That's what momentum indicators tell you too. The buying was drying up here, and then the trend can change. Okay, so the levels, and let me show you what's on the 60-minute charts, things to watch here. No divergence, with little bit of divergence. I have to turn off my lines here and show you. It shows better on the 15-minute chart in the futures. That's what I'm going to show you now. That's QQQ. Let me just look at SPY for you. And we're just focusing right now on the big caps. I'll look at the small caps. I'm trying to give you some biased analysis here. Not just biased, just things that I'm seeing. Okay, this is I'm sorry, IWM, the small caps. They do have on the daily chart by the skin of its teeth, but it still has positive divergence. You can see the indicators making right now higher highs. It's potential divergence. It's not confirmed. We need to make a bullish PPO crossover and get this up. The PPO lines will turn soon, or the divergence will be burned through. But we're back to support. There was this trading range right here. We broke out above it, an impulsive breakout, back tested it, and we're there again. So you have IWM at support with positive divergence. Okay, so that's that. 60-minute chart, that divergence shows through here, at least on, I already had it drawn up on the PPI, not so much, almost equal lows there on the RSI. And again, IWM needs to giddy up and get going now, or it breaks support and the divergences will be gone. Let me jump down to the futures for you real quick. Okay, we'll start out here with the 5-minute chart of ES. I got this out to you earlier today, and I covered in yesterday's video, mentioned right when I started the video. So off the lows yesterday, covered some shorts I came into the day with, reverse long, because we had positive bullish divergence, and I showed you, I think I might have showed you SPY and QQQ, or the futures, or both. And then this morning, it showed through on both of them. This is right here. That's divergent lows right there. And that was it. So then, that was it. It was a nice trade, about 1% or so, right into, you can see nice resistance here. We keep boom, 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 support, boom, boom, resistance, and there was a downtrend line. Same thing I gave you on NQ, and we rallied right into it. So to me, it was an excellent place to reverse. And you had a bearish rising wedge to boot with negative divergence. So it doesn't get much better than that. And that was pre-Fed, and there's what happened after the Fed. Right now on the 5, there's no divergence at all. And the futures are real time. You go to the 15. These are my go-to time frames. You do have, well, you know what? Since after the close, it might have just melted away. Well, sometimes I've noticed, depending on the charting platform, these lines, the fast line, here's the signal line, the white line. If we reverse up, the signal line may change tomorrow, the orange line, and be right up here, equal or higher. And you do have the divergence here. So there's, see, here's the white line right there, the signal line. So there's potential divergence here on the 15. So where I'm going is the markets, here's the takeaway. We broke support on SPY and QQQ on the more significant daily charts, and we closed well below it today. So that is a sell signal. And until unless we get back solidly back above those lines, that sell signal is intact. There is divergence, some divergence here on the, it's there on the 15-minute chart of ES. I'm going to get to NQ in a second. These divergent highs, that was what was on the 5. They just happen to carry through on all time frames on this platform. Annoying little feature or bug. And then this is a 60-minute chart. Let me move that away now. Those again came through from the 5-minute chart. So this is our 60-minute chart of ES, the S&P 500 futures, that is. You have equal lows right there on the RSI and higher lows on the PPO. So there is the potential, but it's going to have to reverse soon and keep these divergences intact. And it's not the be-all, end-all. It's just probabilities. You know me. That's what I deal. Not possibilities, because anything's possible. Probabilities. If these divergences, if we can reverse up here, we start to see some buying, turn up the indicators while we still have higher or equal lows against lower lows and prices, then that can be the fuel, the technical catalyst to get that reversal back above the indexes. But just because you have potential divergence doesn't mean it's going to come through. And if we start to take out these divergences, meaning these indicators go down below the previous lows, then that's just going to help to solidify the bearish case or the reason to be short. NQ, NASDAQ 100 futures, all my lines disappeared. I had a couple. This is the one I gave you this morning. This was that wedge right there, and said, reverse. Same thing as ES I just showed you. That was a downtrend line. I'm just replicating the chart I had this morning, and so that was a reason to get back, close those longs, get short there, and it's been a drop of about 2%. Nothing big. This is 5-minute chart. That's the realm of the active trader. If you're not an active trader, ignore 5-minute charts when I post them. 3-week, 15-minute chart. You can see here you still have, by the skin of its teeth on the RSI, and close enough here on the PPO, positive divergence. So we put that line about flat right there. That's the 15-minute chart, and I like to go out to the 60-minute. And let's see. So you can see there's still the potential here. It's these 60-minute divergent highs and lows that often give you those major turns in the market, just like here's one. Again, these futures rolled recently, so a lot of the trend lines that are annotations I had on the previous one are gone. We're working off the December contracts now. And a little divergent high right there. This is a more typical swing trader's time frame. Divergent high, divergent low. We'll see. So I always say this: divergences are not a buy signal. I see 0 buy signals in the market right now. In fact, I saw big fat sell signals today, or at least sell signals confirmed from yesterday. What would be a buy signal again would be recovery back above those trend lines, above some of the overhead resistance levels and whatnot. What would firm up the bearish case is if we just head on down tomorrow and keep going down. Okay, so earlier this week I pointed out that the VIX was setting up bullishly. You had this is the daily time frame. Quick takeaways. We've had divergence forming from this point here. VIX going on to make lower lows with the momentum indicators making higher lows. This is our positive, aka bullish divergence right there. Each of these were slightly lower lows against higher lows down here. And so we've been moving up. And if you go down the 60-minute chart, same thing. Let's just zooming in a little closer. You can see the indicators moving up against slightly lower lows, almost equal, but pretty much slightly lower lows. And nothing big today, 7.3% on the spot VIX, but you don't trade the spot VIX. What you trade are futures on the VIX, that's my go-to vehicle, options on those futures, or ETNs that track and roll the futures. And so this is the VIX October 18th contract right here, VIX futures. And I wanted to point out, if you're in those, this is the one I'm in right now. You have a downtrend line, positive this is your downtrend line. We close right at it with price resistance about 1656 or so, just above it. Positive divergence here on the 60, my go-to swing trading time frame. And you can see all the other divergent lows and divergent low, rally, divergent high, correction, divergent low, rally, divergent low here. So this is your breakout point. If tomorrow we have more downside, I would say if we have another 2-3% downside tomorrow, we'll almost certainly break out above this level in the VIX and then shoot up to this next target zone here. It's about 1841 to 1886. Try to quantify it for you, roughly about a 13 from where we're at now. Be at least 13% to get to the bottom of that zone. And but if we do that, it's going to further solidify the bearish case as well, and it's going to increase the odds will go up a lot more. Remember, the VIX 13%, that's just daily gyrations in the VIX. You know, if the VIX breaks out, if the scenario, if the top is in the market and we're going to go down, again, I gave you the levels in the beginning of the video that, well, the red lines that will most likely begin to accelerate the selling, where you start to see bigger and bigger moves, 3% down days more and more frequently. And that's where the VIX can really begin to explode. So, those are levels to watch. And kind of sector most closely related, my go-to index for trading typically, and right now is and has been the NASDAQ 100. You want to watch semis. NASDAQ 100 is really, it's just an overlap of XLK, the tech sector ETF, because over 50% of the stocks in the NASDAQ 100 are tech companies. There are no financials in the NASDAQ 100. That separates it, quite a bit from the S&P 500, among other things. And the semis are really I always said, the canary in the coal mine for the tech sector. And they topped here. And we had a sell signal on those guys right here. Short entry, back tested there, rolled over, and then rallied back to that 509, 510-ish resistance. This is that red line I've been harping on. Well, the two red lines. We already broke, as I highlighted earlier this week, we had a sell signal. The red lines were the most important ones that needed to go. That one clearly went. Impulsive breakdown. And we took this one out today, but not by a lot. So this is also, again, Fed Day. Take it with a little bit of grain of salt. If you want to be a purist, we broke it, but not by a lot. We closed at 470.90. Let's call that 471 against a support level of roughly 472.50. So again, I'll take it, but any more downside, and pretty much if we take out today's lows, anything more than maybe a gap down in the morning or early morning gap drop followed by a reversal. How we close tomorrow, and as I like to say, the redder the better. So just look at yesterday or today's lows, and if we are heading down intraday and into the close, and we're well below that helps to confirm this or solidify this breakdown below that 472.50-ish level. And I think on some different boards or time frame, there's my clean board. You just want to see that's the breakdown so far. There's a primary uptrend line off the October lows, well defined, and that's it. That's the breakdown, as clean as it gets. Plenty of reasons to be short. Have been quite a few to be short the semis lately. Thought I might have, I don't know, different boards, probably 60-minute chart. I have targets for you there. Oh yeah, there it is. T1, T2, next target down here, 445.70. That would give us another 5.6% drop to the next target, and that's just short-term stuff. Okay, let's move forward a little quicker here. XLF financials. Down today, nothing huge, down 0.69%. This is XLF, the financial sector ETF. This is my clean board, which has just the most salient levels to watch, which would be this downtrend line, bear market downtrend line. This was the bull market highs back in the beginning of in the beginning of 2022, right when the S&P 500 topped. The NASDAQ led it by a little bit. NASDAQ technically peaked in November, put a roughly equal but slightly lower high there, and that's when the S&P and the financials and everything peaked. So there's your bear market downtrend line. So many key stocks and sectors have recently hit and got rejected off these bear market downtrend lines. I'm going to loop over to Intel in a second because Intel took it out, but it proved to be a false breakout. I'll show you that in just 1 second here. That was that minor trend line I have there on. Let me actually add it here. We're not below it, so there's what you need to watch there. If we head down much more, we're probably going to head towards the bottom of the triangle, and then whichever way this breaks will almost certainly depend on whether the market's going to do that marginal new high scenario. If it does, financials are going to break out. I severely doubt the stock market, the broad indexes are going to new highs if the financials go down to the bottom, and especially if they break the bottom of that triangle. So that's what to watch, one thing to watch. And then you have all my favorites, the leading financials. These charts are just one after another, beautiful bearish patterns to me. These are nice looking short trades, and it's taken a while, and I've been talking about these for weeks now, if not months. But that's how it is. I've always said, one of the many phrases I've come up with in trading is, patience is a virtue in life, but it's an absolute necessity in trading. So, you watch. These divergences build. You have a divergent high, another one. But the divergences are getting larger and larger, and it leads to a bigger drop. And then finally, when they play out, last time we had a comparable wedge, a rising wedge with negative divergences, Visa fell about 32%. I don't see any reason why it's going to fall anything less than that once this wedge breaks, but it hasn't broken. So there they are. I started to get a few alerts today, but those that I had closed right back on there. Let me show you. One of them was I had AXP, American Express go off, but we're right on the line. I had SPGI, S&P Global, right on the line. These are all big components of XLF, by the way. These are the financials. So there's Visa on the line. JP Morgan already broke down. Sell signal intact. Needs to break the yellow line right there. MasterCard, beautiful bearish rising wedge, just ready to pop. So this is it, guys. I'm saying the same thing over and over, but I think we're at a very critical juncture. To me, the charts are clearly bearish despite the trend. Now, that's where I know I confuse people. This 99 out of 100 people look at this say, Randy, you're crazy. You're seeing things. This is one of the most bullish charts I've ever seen. This stock couldn't be in a more clear uptrend. That's the definition of uptrend. All-time highs. Stocks going up and up. Little corrections are getting bought up. I see different things. I see a stock, yes, I recognize an uptrend. I am not short Berkshire. Can't make a case to short it right now. But if it breaks this trend line, I can definitely make a case. And based on the look of the chart, I'd give it very good chance that a breakdown's imminent. It's at that point right now. It's approaching the apex of the wedge. If it's going to break down, it should do it sooner than later. BAC, right on the line. It's all these financials. Are just a lot of them right on key support. American Express, Goldman, Schwab just broke down recently right here, that minor trend line. BlackRock, there they are. MMC, Marsh McLennan. All right. Let's look at the regionals. That's the big financials. Regionals continue to move lower. I don't know. I didn't watch Powell's entire press conference. I caught a little of it. I didn't hear any mention about the regional banks. I don't hear many people talking about these, I guess, because that, I forget the name of the bailout program they put in where they can dump all their useless underwater treasuries off on the Fed at par value, but that's supposed to expire soon. But either way, what I can tell you is the regionals have been moving down, and that's not a good sign. Like I said, I've said this before, any one regional bank up until Silicon Valley, none of these regionals were deemed too big to fail by the Fed. But of course, when those three went down last year or earlier this year, I'm sorry, then all of a sudden they retroactively declared them too big to fail and did the bailouts. Now, so what I was going to say is, and I've said recently, although any one of them, let's just say, is not let's just go with that they're not too big to fail. Collectively, they are, and collectively, they all have the same problem. They do the majority of commercial lending, and we know what's going on in the commercial real estate market. At least those of you, if you read up on it, do. We got vacant buildings everywhere. Lots of issues there. So, and that I don't see going away anytime soon, especially with the persistent high rates, which will lead me to the next thing, TNX. So, okay, everyone talks about the Fed. And I even heard one guy, right after the press conference, that guy, I forget his name, he's on CNBC, they always bring him on a Fed day, and he said, well, of course, if the Fed raises rates, it's going to bring Treasury rates up, so you should buy bonds or keep rolling money into bonds, whatever. No, that's actually not accurate. The Fed controls the federal funds rate, an overnight lending rate. We're talking 24-hour rate, if you will. This is the 10-year Treasury yield. You can look at the 30-year bond. The Fed does not control those. They can try to manipulate the bond market to an extent, but they ultimately, market forces will do that. So, okay, let's just say that. What happened? Let's say the Fed, we see persistent high inflation. We know what's going on with oil. I pointed that out. Other things going up, housing markets staying persistently high. So if the Fed is forced to keep rates high or even raise them higher, and they've acknowledged if they have to do it, price stability is first and foremost. They will push the economy into a recession. They've pretty much, if they haven't outright said it, they've implied it pretty clearly. And so where that is, rates, we could see rates go up, and they do. It's going to dampen future economic growth expectations, and that's what brings yields down. If bond traders think that in a year, 2-3 years from now, we're going to see a recession, and that means long-term rates and most likely inflation are going to fall. So yes, you can see short-term rates go up and absolutely see long-term rates fall. Another variable is we know the whole debt ceiling thing is getting worse and worse. We've never had such gridlock in Washington as we have in recent years, in the last couple administrations. I'm drawing a brain fart there. And I don't see that getting better anytime soon. So we'll see what happens there. But there's another thing. If we can't get our own house in order, you're going to have both institutions here in the U.S., pension funds and elsewhere, and other countries, Japan and China and all these other countries, our bonds aren't going to look as attractive. Ultimately, we know we're going to just end up strategically defaulting, which means not that U.S. will always pay its debt. They're just going to print more money to pay that existing debt off. And then there's a whole thing about the debt load that we're trying to service right now. You've probably read up on that. It's tremendous. These higher rates, 5.5% Treasury yields, and what it's costing the federal government now just in interest costs. So we can't keep up what's going on here. So I just want to say there are many forces that can bring long-term rates down, and even if short-term rates go up. So where I guess I'm going is just trade the 10-year or track it on your own, even if you're not trading it. But it was up today. Or no, well, it looks like it closed. It was basically flat. But look what we're doing. We're compressed. We're pushing right up on that key level. Remember, this is the multi-year high here from 2022 in October, right when the stock market bottomed, right there, right? And it also, you have to go all the way back to 2007. So this is a big, big level if we break out here. And that's going to be very constrictive for economic growth, okay? And like I said, there's a scenario that I see, one that's, I think, very likely, that rates actually go down, but it's not bullish, where normally everyone would say, oh, if I told 9 out of the 10 folks that are coming on TV, experts that hey, I'm calling for a 3% drop to a 3% yield in the 10-year, they would say that'd be uber bullish and the stock market would explode. Well, that could be the case, but as I've said, if yields are dropping because of a stock market drop or crash, a very strong, swift move down, comparable to what we saw last year and what we saw during COVID, then that would not be bullish for equities. It would be caused by a flight to safety, big institutional buying, money moving into treasuries out of equities. So I know I'm throwing a lot out there. There's a lot of things you can do, but the takeaway here is we're at a big technical juncture. And so So we'll watch this, and sooner or later, and it has to break out. We're really pinching at the apex of that giant ascending triangle pattern there, and we'll break one way or the other. And when we do, I'll look at junk bonds, I'll look at corporate bonds, credit spreads, what the stock market's doing, and we'll try to determine whether that is net bullish for the stock market or net bearish. And of course, if there's a trade to be made, then I'll highlight that as well. In treasuries, that is. All right, this has gone long. I was going to cover the euro. Euro was up right away and earlier today, and then it got faded. There was a rally. This is earlier, and you can see a big drop. There's the Fed meeting right here, and so the euro dropped, dollar rallied, and that was gave us. We had a nice, you had a nice opportunity to exit. Silver today hit that third target here. Silver was a long right here, first, second, third target. Went a little bit higher, and it's now down below that. I still think it's got a good chance to come up here. What I did today was when it hit that, I set a relatively tight stop, which I got taken out of immediately after the Fed. They had a little spike, and they got me on that. But then it's actually closed back down. I'm in the futures, and they're still trading, but that was the post-Fed spike right there. So they got me, and it was a good thing. At first, I'm like, that's half my share. So I'll let you know right now, and I'm just letting that other half, it's a small position, ride for the time being. I still think there's a potential here that we could get a rally in the euro, which would lead to a spike in gold and silver, another leg up. We're at support on the euro right now. We've been there for a while. This is a daily chart, and there's a downtrend line. So I still maintain these additional upside targets. It just, like I said, today was a good time, especially with the Fed meeting and all that, to at least take some partial profits. It's not a big trade, 5% or whatever from that recent low, but 5% a week. You do that just once a month, and you do that 12 times a year. You're talking over 60% non-compounded. So it's not always that easy, but that's it. So that's what swing trading is all about. You don't have to hit home runs on everyone. Just get your 4, 5, 10, 20, 15%, whatever the trade is, and move on to the next one. Okay, I'm gonna wrap it up here, get the video out to you guys, and yeah, we'll watch. We'll see what happens tomorrow as the dust settles. Again, on Fed Day, the odds of a whipsaw are elevated, and with each day afterwards, the market will finally usually show its hand in which direction it wants to run. And as of today, like I said, it was net bearish on the technicals, everything I covered, and I talked about what the market needs to do to undo today's bearish developments. Hopefully that makes sense. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.